Are you feeling nervous about the next stock market crash? Are you fearful that we might see another crash like 2000 that took over 5 years to play out? Well, I'm not surprised. The headlines are flooded with negative news. Market valuations are at all-time highs, and you've got billionaire investors coming out predicting the next stock market crash is just around the corner. It seems like everyone is nervous and a stock market crash is imminent. But is it really? Is this time really different? Or is it all in your head? Hello and welcome back to the channel. For anyone that's new here, hi, my name is James. I'm a chartered wealth manager, and this is a place where you can learn to make smarter financial decisions. From reading the news, looking at alarming stock market charts, and watching the endless number of stock market crash videos on YouTube, you could easily think that the next stock market crash must be just around the corner, and that investors are more nervous than they've ever been before. But is this really true? Or is it all in your head? Well, in this video, I'm going to show you how the sources of information that you're using to make decisions are giving you a warped view of reality, and that things are not quite as they seem. I'm also going to show you why you've been reading graphs wrong all your life. I have been helping people invest their money for the best part of 10 years. Even right now, I'm speaking with several people that are looking to make large stock market investments. And I can tell you, they're feeling pretty nervous by what they're reading in the news. But there is nothing new about that. Every single person that I have helped invest over the last 10 years has been nervous about something that they've read in the news. You're probably thinking that those headlines couldn't possibly be as bad as what's going on now. But just to take you back in time a minute, I'm going to go through some of the events over the last 10 years, and I want you to think about how serious they seemed at the time. In 2012, we had the European debt crisis, where Greece almost went bankrupt and took the rest of Europe with it. In 2013, the taper tantrum, where the US government started to reduce the amount of money that it was pumping into the markets. There were inflation fears, and it was pretty similar to what we're hearing today. 2014, the first US government shutdown, where the US government was days away from closing its doors. In 2015, the Chinese stock market crashed by over 45%. 2016, Brexit, which was the biggest event to have happened to the UK and the European Union since its beginning. In 2018, we had the trade war, where Trump kept threatening to put higher and higher tariffs on China. And then in 2020, we had coronavirus. With each of these events, newspaper headlines read like the end of the world was just around the corner. But every single time, fears were overblown. And over this period, the S&P 500 was up 495%. So why do these events seem so serious if they're just likely to blow over? Well, that's because negative news sells. Negative news is what gets the views, it's what gets the clicks. And no, it's not just the Daily Mail that is guilty of this. Here's an article from the FT just last week. Inflation could spark a new global financial crisis, says Russia's central bank. Sounds pretty serious, right? But if you look down here in the body of the article, you'll see this. The prediction is not the central bank's central scenario. This instead foresees a broad economic recovery with inflationary pressures dissipating by the end of the year. And this is significantly more likely. So despite Russia thinking that a broad economic recovery is the most likely scenario, this journalist has zeroed in on this remote possibility just because it's going to get more clicks. And this is why you can't trust headlines. And it gets even worse if you get your news from YouTube or Facebook, because as soon as you start clicking on these headlines, that's all you're going to see. And you'll start to think that everyone is thinking and saying the same thing, but they're not. You're just stuck in an echo chamber. The algorithms within these platforms are designed to keep you engaged for as long as possible. And the way they do that is by showing you more and more extreme content. And the more extreme it is, the more likely you are to be engaged. And this can result in you ending up having quite a lot of extreme views. I mean, this is the reason why we've got groups like QAnon, flat earthers, or day traders that think a 200% return is achievable and sustainable. But hang on a minute, this time we've got people like Michael Burry, Kevin O'Leary, Ray Dalio coming out predicting a crash. These are some of the smartest, most successful investors of all time. Surely they know what they're talking about. Well, do they? I bet for every famed investor that's calling for a stock market crash, I can find 20 that aren't. But to you, reading the news or sitting there scrolling through YouTube, these extreme voices are the only ones you're going to hear. But again, there's nothing new about this. This is one of my favorite things to look at. This is a very small sample of some of the calls big name investors have made over the last decade and just how wrong they have been. The next crash will happen by year end. Prepare for a massive market meltdown. Sell everything, brace for a cataclysmic year. Once in a lifetime crash coming in the next 3 years. Despite all of their conviction, every one of them got it wrong. So before you go acting on the words of a guru, just remember this. Firstly, their message is almost always taken out of context. There are hundreds of YouTube channels that literally only regurgitate interviews and sound bites from these gurus as if they're gospel. But these snippets are often taken out of context, and as a result, the message becomes distorted. There is a big difference between a passing comment on a random podcast compared with what actually gets fed into their investment strategies. Ultimately, talk is cheap, and if you keep calling for a crash, then you're going to be right at some point. And the second thing you need to remember is that everyone has an alternative agenda. They're all trying to sell you something. Michael Saylor, who won't stop banging on about Bitcoin and how the death of fiat currency is just around the corner. Well, of course he is. He's got $2 billion invested in Bitcoin. Cathie Wood of ARK Innovation is predicting that this bull market is going to go on for another 10 years. Well, of course she is, because she wants you to invest in her extremely bullish growth funds. And then on the opposite side, you have people like Crispin Odey, who is a notoriously bearish investor who calls for market crashes more than anyone. He's just trying to get his message out so he can connect with other people that are feeling nervous about the markets, and ultimately other people that are then going to invest in his very defensively positioned fund. It's all a form of marketing, and it works. As individuals, they all have large social media followings, but because some of their names have become keywords in and of themselves that will drive clicks and views, you have blogs and YouTube channels just regurgitating their content sound bites and snippets, which means that their reach is even bigger than you might have originally thought. And in some cases, their power is so great that their prophecies actually become self-fulfilling. Just think about Elon Musk that can crash the price of a cryptocurrency just with a single tweet, or short sellers like Muddy Waters that just have to release a report on a company and they will immediately crash that company's share price, even if there's very little truth in that report at all. So you have content creators, algorithms, and billionaire investors all trying to distort your view of reality. And because our brains are not built to process this amount of negative information, it can lead you to believing that the world is in a much worse state than it actually is. We humans have evolved to live in small villages or small tribes where bad things rarely ever happen. But now we're bombarded with negative news from across the globe, and it's turning us into anxious wrecks. When the truth is, we are living in the most peaceful and prosperous time of human history. So please, give yourself a break from all this bad press. Now, one of the other reasons why people often feel nervous about investing is because of this. This is the performance of the S&P 500 over the last 50 years. And looking at this makes people feel nervous. Look at how steep the growth has been over the last few years. It looks like it's been growing faster than it ever has before. But has it really? Well, you can't really tell from a graph like this because linear graphs distort your perspective. Let me explain. In the 6 years between 2015 and 2021, the stock market doubled from 2,000 to 4,000. And as you can see, that looks like a massive jump up. But the stock market also doubled in the 5 years between 2009 and 2014. But because that was only from 1,000 to 2,000, it looks much smaller on this graph. And if we go back even further to the 6 years between 1988 to 1994, the stock market doubled again from 250 to 500. But again, that looks even smaller on the graph. But if we go back to look at this graph at that time, you can see it's very similar to the pattern that we've got today. And from that point, the market then went on to quadruple over the following 6 years. But a linear scale like here on this y-axis that goes from 1,000 to 2,000 to 3,000 gives much more weight to recent moves, which is why when we're trying to observe rates of change and trying to think about exponential growth, we actually use a logarithmic scale. Now here I'm using Yahoo Finance, and if you click on settings and then tick logarithmic, this is what you see. Now you'll notice that the y-axis has changed. So instead of going up in even increments, it's now doubling at each interval. So the distance from 30 to 60 is the same as the distance from 60 to 120 and from 120 to 240, which means that if the market doubles at any point in time, it's going to move exactly the same distance on the graph. These types of graphs are used wherever we're investigating how growth rates have changed over time. As with coronavirus, where we were much more interested in the R number, or the rate of change, than the actual number of cases that were happening each day, which is why you will often have seen logarithmic graphs used to show how the rates of infection had changed over time. And the same goes for stock market returns. And as we can see here, stock markets have actually grown at a fairly consistent rate over time. Yes, we've had a slightly better run of late, but nowhere near as good as that linear graph was making out. Now, you should never make decisions purely based on patterns that you've observed in charts or graphs. But I just wanted to highlight this because this is something that people often get wrong, and it makes people feel nervous about the state of the stock market for no good reason. Now, the point of this video was not to present loads of evidence of why I think this bull market is going to continue, or there might be a crash in the next couple of years. But what I wanted to show you is that you really need to take those headlines and all of the content you find on YouTube with a very large pinch of salt. And I wanted to make sure that you're not getting panicked by graphs that aren't really telling you the true story. In my humble opinion, there is no point worrying about things you cannot control. And a stock market crash is certainly something that you cannot control. But on the flip side, you know that over the long term, the stock markets are going to keep on marching on. And as an index investor, the only way that you can ever lose money is if you're forced to sell when the markets are down. And the only reason people are forced to do that is because either they haven't done their cash flow planning correctly and they've been forced to sell because they need the money, or it's because they've panicked. And these are two things that you are very much in control of. Just make sure you have enough cash on the sidelines to see you through any storm. Make sure that you're taking an appropriate amount of risk that is right for you, and give yourself a break from all these negative headlines because you're just making yourself anxious and nothing good's going to come from that.